Welcome to my channel and to the second video in a three-part series on how to overcome the most common obstacles that I come across for investors. Over the past 30 years, I've studied a lot of academic research and the lessons are clear. Investing in the stock markets is an excellent plan for meeting long-term goals like maximizing your retirement income. So why don't more people do it, and why don't people understand what they're doing? What's also stopping them? So the aim of this video series is to address these obstacles and help you overcome them. The first video looked at the first 4 obstacles, which were thinking it's too late to invest, not knowing who to trust, being afraid you're going to lose it all, and not knowing when to get into or out of the stock market. In this video, I hope to tackle what I hear as the next 3 major obstacles. The first of those is, I don't know what I don't know, and that makes me nervous. You know, that's a good thought process. If you already have got the humility to go, look, I don't really understand all this. I haven't got all the answers. What you're then going to be able to do is maybe do some research like you're now doing and go, right, okay, let's see if I can get my head around this. Let's see if I can get to understand it. Because once we get some understanding, you can hopefully then take some action and put an investment plan together that meets your goals. Now, investments are all about, we need to have some volatility, some risk involved to get the return. There is no return without risk. If we want to just lend our money to the banks, and that appears not to have much risk, but obviously the banks could go bust as well. But if they're not going to pay us a huge amount of return for the security a bank deposit gives us. If we understand that we want to invest in companies of the world or products of the world, companies that produce the products of the world for a return, then we understand that those share prices that we're buying in may be volatile, and therefore we need to understand what we're getting involved in. So I'll put a little list in below of some good stock market books that you can educate yourself on. There's a lot of YouTube now, but you've got to be particular about where you get your advice from and who you take it from. Because obviously there's lots of people, lots of proponents of different things, and you've got to kind of try and filter out the information that you get to make sure that you understand what you're getting yourself into. So your challenge is to understand a bit more about investments. A financial advisor obviously can help you with that, and then actually stick to that plan. Actually, a bit like going to the gym and getting some advice from a personal trainer, but then actually sticking to the plan of actually what you've been advised to do. Next up, something I hear quite a lot is that I only want to invest in companies I'm familiar with. Now, knowing the companies is not the solution. You would not have been wanted to be invested in blockbusters. I mean, a number of years ago, you'd have thought they were a fantastic company. They were on every high street, on every corner of every street. For the younger of the viewers, you may not even know who blockbusters were. I understand they even turned down buying Netflix for an absolute bargain price because the directors of the board said, no, we're making too much money in late fees. Those are the fees that you used to have to pay if you didn't return your DVD or your video on time. So you paid late fees. So they didn't want to get into streaming. You wanted to get into Amazon or Tesla, Amazon back in the early 2000s, before they became the huge successful companies out there. So when you buy into a globally diversified portfolio, of course, then what you're doing is you're buying some of those smaller companies as well as the larger growth companies in the market. You're getting a really great spread of companies, and maybe some of those companies you actually don't know because you can't identify them. In the portfolios we run here at MFP, we have about 11,000 different companies in the portfolios. Some names we've heard of, some names you won't have heard of. The stock market contains all the publicly traded companies out there. The next thing I hear is, I'm afraid there's going to be another stock market crash, another financial crisis. It's true, there will be, there always has been, but we've always seen a recovery afterwards. So I want to give you a little bit of a history lesson just to show you what the performance of the world stock markets and the different asset classes that you could have invested in going back over 100 years worth of data. So number 1 here is global equities. So you can see that the long-term return is 12%, and the highest return that we've had in a 1 calendar year period has been 56%, and the lowest return has been minus 30%. That's even 75%. If you just go follow the number one down on the left-hand side, 75% of the time global equities have been positive in their return, and 25% over a 12-month calendar period they've been negative. And if we flip then into another equities, into companies, emerging markets, you can see that the annualized return has actually grown to 13%, but there's been more volatility. So the greatest return has been 85%, and the poorest return has been minus 36%. Then we've got different portfolios coming together: growth portfolio, a balanced portfolio, and then we've got bonds. UK property, I think, is quite interesting. So we've got a 7% annualized growth, 44% the greatest return we've seen, and a minus 15% property downside. But 82% of the time you had positive returns on a calendar month basis. And then we've got gold, 8% annualized return, and the different figures there. Cash, we know, a poorer return, but we haven't. 100% of the time we've had positive returns. Obviously not against inflation, but a positive return on your cash. And then if I just jump myself out of the way here, we've got inflation there. I think is really quite key. 4% inflation, so you can then compare the returns against other figures of what you'd have got in the stock market. And the UK equity figures you can see is coming at 12%, and minus 52. So that's been more volatile than the global equity portfolio. Hence my usual recommendation is to be more diverse than just in the UK period. But there's a bit of a guideline to actually see why history about the next crash is not so important. Actually, about getting invested and staying invested over the long term will see you through those volatile periods of when the market is downturn. And in fact, you might even be able to take opportunities if you're regularly investing in those periods where the stock market has fallen. And of course, you'd be buying into those equities, buying into those companies at a lower price than you did before. So there you have the next 3 of the 10 most common obstacles I hear to investing. Why not subscribe to be notified when part 3 of this series is released, and please check out part 1 if you haven't already watched it. Thank you so much for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help you live a successful life, and that often involves you understanding your money. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel. For now, I'm Justin King, helping you live your best life.